Okay, I think we're good to get going. Good morning, everyone. Thank you for joining our fourth installment of our series of webinars on COVID-19's impact on the Bay Area. I'm Isabel Monteleone, and I'll be your moderator for today's session. In my current role as a research analyst for the Bay Area Council's Economic Institute, the Council's research think tank, I help analyze data and produce research reports on key issues facing the Bay Area economy. So alongside the Bay Area Council, our Economic Institute is working to aggregate economic data points and understand the broader impact of COVID-19 on the economy. So far, if you go to our website, bayareaeconomy.org, you'll see we've put together some studies on unemployment claims, the economic vulnerability of residents in the region, and recent trends in Bay Area mobility under the shelter-in-place mandate. Again, you can find these insights at bayareaeconomy.org. We're also in the process of getting started on our economic profile in partnership with McKinsey. This is our 11th report in the series of economic profiles we've produced since 1997. In the coming weeks and months, we're planning on organizing webinars on several economic data points that we'll be tracking and also engaging with regional stakeholders just to better understand the major themes and focus areas that are emerging from the crisis. Okay, so before we get started, I just want to remind everyone to pose any questions you might have in our Q&A box, just right at the bottom of your screen. And at the end of this session, the BSC team and I will work to organize those questions for our Q&A at the end. So we'd like to make this session as engaging as possible, so please feel free to add any questions you might have to the Q&A box. Okay, so let's get started. Today, you're going to be hearing from Katie McDonald from Bank of America and Jerry Nickelsburg from the UCLA Anderson forecast, both which will be sharing their insights on COVID-19's impact on the national and state economy and providing forecasts for future movements across several markets. So to begin, we're very grateful to have Katie McDonald here with us today. She's the Vice President and Investment Strategist at Bank of America. In her role, Katie is responsible for the analysis of global economic and financial market trends, focused specifically on international economics and political economy. And her analysis supports economic forecasts and technical asset allocations, guiding the wealth management businesses. We're also really excited to have Jerry Nickelsburg, director at the UCLA Anderson forecast. For the last 60 years, the UCLA Anderson forecast has produced forecasts for the economies of California and the US. And the forecast was unique in predicting both the seriousness of the early 1990s downturn, as well as the state of California's rebound in 1993. And the forecast was also one of the first in the state to claim that the US had entered a recession during the COVID-19 crisis. As a forecast director, Jerry is responsible for analyzing and forecasting the California economy, and he's also conducted some special studies on different industry sectors like manufacturing, aerospace, and construction. Okay, so we'll kick things off beginning with Katie. Katie, thank you for joining us today.
Thank you so much, and thanks for having me on the webinar. It's great to be on. Now, this is truly an unprecedented crisis we're facing, and I might use that word a couple times today. So just a bit of background. Prior to my work in the Chief Investment Office at Bank of America, I used to work on the stress tests that the bank would submit to the Federal Reserve, where we would, take hypothetical scenarios of severely adverse economic conditions and model how the bank could weather the shocks. Well, just using that as an analog to what we're seeing in the markets today, when I look at what the US and what the world is facing, it's truly as if we have entered into one of these severely adverse scenarios. One that few could have predicted entering into 2020. And to summarize, just before I dig deeper into some of my slides, the US did enter the crisis from a position of strength. This is a severely adverse exogenous shock to the US and global economy, particularly harmful as it's both a demand shock and a supply shock. There's a high degree of uncertainty on the potential outcomes, and the amount of weeks of delay in getting the economy back up is nowhere near certain. So the bottom line is what we're seeing play out in the economy and the financial markets is unprecedented. Never before has a broad shutdown of the US and global economy been applied like we're seeing today. And, this recession was deliberately engineered to address the health crisis. It's caused the economy to flip from this broad-based strength, which we saw, coming into January, and to a position of sharp decline. So a key part of the story is the unprecedented policy response as well, which I can get into later. But I'm going to start, if you turn to this first slide that I have in the deck. Now, here I just want to highlight the importance of the service sector in the U.S. economy. When I spoke at the Bay Area Economic Outlook event in January, I had mentioned that watching this service economy in the U.S. was key to predicting the economic outlook. So very rarely has the U.S. entered into recession without the service economy turning over. This was important at the start of the year as we were discussing and analyzing before COVID-19 because manufacturing weakness around the world and in the U.S. Was causing some fears of a recession. Yet a recession would likely occur if those manufacturing weaknesses would seep into the services sector. Once COVID-19 arrived in China, we also started to see some of the manufacturing supply chains, taking a hit. What's different now is that there are a wide range of economies around the world implementing these social distancing measures. Stay-at-home orders have a direct effect on the service sector. So rather than an indirect effect by having manufacturing weakness gradually seep into the services sector, this is a direct effect on the services economy, which, as you can see from the chart on the left, has become a more and more important, actually services economy is displayed on the chart to the right. So it's been a more and more important part of the U.S. consumption, as well as 85% of employment is in services. This is also important because the U.S. personal consumption as a percent of GDP has been rising higher and is almost 70% of our economic outlook, as opposed to the rest of the world where this has been a less important part of the economy. So looking back at other crises, the services sector and the U.S. consumption tends to help prevent more volatile movement in GDP because consumption is by nature less volatile than investment by businesses, inventories, etc. However, this crisis is different because consumption is having a very volatile effect on growth, which we believe will cause this recession to be one of the deepest in history. So now, turning to the next slide, I just want to take a look at the services sector in the Bay Area, particularly. This is a key part of the economy in the Bay Area is in services. So just going through some of the stats, professional, scientific, and technical services employ the most workers in the Bay Area at about 15%, followed by healthcare and social assistance, and government as well. Both of those have about 10% of employment. And then accommodation and food services and retail, which are heavily hit by this crisis, each have about 7.5% of employment in the Bay Area. A lot of these jobs are able to be done remotely, particularly the professional and business services sectors, but they just represent about a quarter of jobs, meaning a lot of workers, will not be able to do their jobs at home. And just to reiterate, the chart on the right shows the percent of workers who can work from home. This is just a national average. It's not Bay Area economy, but it gives a sense of which industries are able to do their work remotely, and a lot in the Bay Area might not be able to. So finally, I'm just going to turn to the last slide, which shows our updated economic forecast from Bank of America Global Research. Here we're expecting 3/4 of U.S. GDP contraction with growth down a cumulative 10.4%. Ultimately, it is a sharp cumulative contraction in growth, the sharpest in history, followed by what we are expecting is a sharp upswing. So a 30% downturn in Q2 would be followed by a 30% upswing in Q4. This still leaves the U.S. economy below potential, which you can see from chart 2. So not to get too much into the math, but it's important. If you fall in GDP from a high base 30%, rising from a lower base of 30% will not get you back to the level of GDP before. So we think it could be a more slower pace back to where we were growing prior to the crisis. Unemployment could peak at over 15%. And finally, chart 4 shows kind of what I had mentioned earlier about the fiscal stimulus in response to this crisis. So it's been over 10% of GDP with the latest $2.2 trillion CARES Act, a huge contributor to helping this economy stay afloat during this crisis. It's caused many of our clients to worry about the fiscal deficit, with these forecasts expected to rise of the deficit. But policymakers worrying about the deficit at a crisis like this is not a wise strategy. In my view, this is a historical decline in GDP and thus needs a historic response. So a failure of adequate stimulus in this downturn, could provide further problems and a more prolonged economic contraction. So the government responding with this force that it has, as well as the Federal Reserve using all the tools in its toolkit and more to come, has been very kind of welcoming for the markets. We think the U.S. government does have the fiscal space in the U.S. to weather much of this economic burden and take some of the burden off of U.S. consumers and households and businesses, and increase the government debt as a percent of GDP. We don't think this being a problem, rising deficits, given that inflation remains very low, and we're seeing a deflationary impact, especially with oil prices declining, and also with interest rates so low. So with that, those are just my opening comments, and happy to take any questions in the chat.
Thank you so much, Katie. Just one question going off of something you brought up. As you mentioned, the Fed employed many of its tools to avoid a financial crisis. What other strategies can the Fed use going forward, and do we see more monetary policy interventions coming, and if so, what?
So I think the Fed definitely has room in its toolkit to respond to any further weakness. If we see further market stress, this is definitely a possibility. Yes, the pace that the Fed has reacted has been astonishing. It's encouraging for the financial markets that the Fed is now in quote unquote whatever it takes mode. It's ramped up its funding facilities, which were introduced in the 2008 recession. Some are new as well. So the Fed said it will invest today up to $2.3 trillion in loans to aid small and mid-sized businesses, state and local governments, and purchase some additional credit and be able to fund these purchases of other types of bonds, such as high yield bonds. So this is, encouraging to see that the Fed is there to be able to support the markets and help us get to the other side of this crisis. An important part this time also is that the Fed has, committed to open-ended quantitative easing. So they're purchasing whatever amount of securities is needed to support the markets and the economy and business lending, and their balance sheet can expand a lot more. I think what we're going to see in this post-coronavirus environment is, a shift from small government to big government. So the government increasingly stepping in, fiscal as well as monetary stimulus, and stepping in, especially since the U.S. government has the capacity with until inflation gets to concerning levels, which is by the Federal Reserve definition, 2% is the inflation target. And we have seen the Fed, miss these inflation targets for, the last decade or so. So until we see inflation starting to pick up and become concerning, the Fed can continue to, print money and support the economy.
I'd love to hand it over now to Jerry to learn a little bit more about the UCLA Anderson forecasts and just to go into some specifics on California's impact from COVID-19.
Well, good morning, and let me bring up some slides. Let's see, what do I want here? I think this may be it. Yes. So what I'd like to do is take you through some of our thinking on this, and this is going to be a little bit more pessimistic than what you just heard. But what you just heard was that we're in an unprecedented time. And as we look to data to help us discern what's going to happen with the economy, we find that there's not a lot of data on pandemics and how they affect the US economy or how they affect economies in general. And in fact, when the analysis has been done that looks at global pandemics such as the 1917 to 1919 influenza pandemic, that was analysis of very different economies in a very different world than we have today. So we're using our best judgment, trying to use the best data we have in order to discern this. But one thing that you all should understand is there's a great deal of uncertainty about any forecast today. There may be upside to it, there may be downside to it. And so what I want to do is highlight how we get to our forecast and what some of the uncertainties are. And in particular, what are some of the assumptions that we have to make to get to the forecast. So let's just start here with what has been done kind of previously with data. And the best that we could come up with was the SARS epidemic that occurred in 2003. It lasted for about 3 months. It has been studied by a number of economists, and Lee and McKibben put together a model as a worldwide model of the impact of this, separating out how SARS affected the world economy versus other things that were happening at the time. And their analysis looked at this event. There were only 8,000 confirmed cases, which sounds pretty small right now. Only less than 800 fatalities. It was affected 17 countries, very high fatality rate, but it was mostly confined to China, Hong Kong, and Taiwan. And when you think back to 2004, that was not the globalized world that we have today. But nevertheless, they estimate a global economic impact of a decline of $40 billion, 0.1% of GDP, and that being mostly focused in China and Hong Kong. So this model seems to have, pretty good, have a pretty good handle on what happened with SARS. Using a similar model, just updated, McKibben and now Fernando at the Brookings Institute on the 2nd of March did an analysis of what COVID-19 might do to the world economy and our economy. And they came up with 7 scenarios with between 280,000 fatalities and 67 million fatalities worldwide. They don't have a shelter in place. That was not assumed because that was really not part of what was happening then. There's a demand impact that was estimated from past behavior, but the kind of supply interruption that we had was not modeled because there's no real data on that supply interruption. And as Katie said, this is both a supply shock and a demand shock, the supply shock being supply chain interruption. But their impact, well, one of the scenarios, scenario number 4, had 236,000 US fatalities. That's what some epidemiologists are predicting today. And scenario 6 has demand restrictions, which in their case was because of fatalities, but gives us kind of a better handle on what might be happening today, where the demand restrictions are to avoid fatalities, but maybe have the same impact on the economy. The global economic impact they estimate is 9.2 trillion US dollars. On the US, it's an 8.4% decline in GDP and a $1.8 trillion decline. So what are the issues? They don't really match up to the new reality of the COVID-19 pandemic. This being early March, it's not really a criticism of them, but it limits the usefulness, but it does provide an order of magnitude. So that's what we have based on models, based on actual data. And let's look at the new reality. This is the state of the restaurant industry, and flattening the curve has changed the game entirely. That is, normally with a recession, you enter the recession because people have enough of whatever it was they were purchasing, whether it's homes or computers, military hardware at the end of a war, kind of whatever. In this case, it's not a lack of demand, it's a mandated lack of demand. And the chart you see here is daily dining reservations from the app OpenTable. And they go along in February about what they were, the year before. So this is year over year change. And then they fall off a cliff in various states in the US as well as internationally. So that's really quite new. Same thing in travel and tourism. And this is the number of US air travel passengers per day, international and domestic. The top line is 2019. And as you see, this falls off a cliff as well. It goes from 2.5 million, about 2.25 million, down to almost zero, just a few 100,000. And all of this has resulted in unprecedented initial job claims. We're now up to about over 16 million claims for unemployment insurance due to job loss over the last 3 weeks. And that's more than 15% of the workforce. So this is uncharted territory that we're in. And where does that leave us in terms of a forecast? So, we agree with the earlier forecasts that we're going to have a decline in GDP, peak to trough, of about 10%. We see that going through the third quarter of this year. That declined 28.7%. That's about 30% that you heard earlier. That's on an annualized basis. It ends up being about 7.5% loss in GDP relative to the previous quarter. So very deep trough that we're going into. And we have relatively rapid recovery, but that recovery is much slower than the previous forecasts that you've heard. And to return to the 2% growth path, that's late 2022. So as you see here, we don't have that sharp 30% recovery going on. And these are all annualized rates that you see in the chart. What is the reason for that? What is the difference? Well, first of all, in manufacturing and in construction, our view is that work in progress is going to finish, and then there are going to be layoffs. And secondly, as we start easing restrictions in the third quarter of, end of the second quarter, third quarter of this year, restrictions on mobility, restrictions on having businesses open, businesses are going to open up and they're going to try to make it, but there are going to be quite a lot of them that were marginal and aren't going to be able to make it. And so then they will be failing, we'll have bankruptcies, and those bankruptcies will retard the growth rate as we go through 2021. So we'll have growth, but it takes time between when a firm closes and a new firm opens up to serve that demand. So we've got a slower growth rate, and what that means for employment is 11.2% decline, peak to trough in employment. That's greater than the GDP decline because these jobs are being lost in leisure and hospitality and in other service industries, including retail, which are lower skilled jobs, so a lower contribution to GDP. The recovery is going to be slower than GDP. And we're not going to get back to where we were in the fourth quarter of 2019 until the third quarter of 2022. We have a total average quarterly job loss peak to trough of 18 million. It'll go below that, but as firms open up, they'll be hiring back. And so that gives us our job loss. So you've seen these before, that the Fed is pushing liquidity into financial markets to try and keep financial markets open so that when firms that are creditworthy have projects, they'll be able to obtain financing. We're not seeing negative interest rates, but what we do see is a move towards the dollar. This is the trade-weighted US dollar on the right-hand side. And that means that US exports are going to be more expensive. So that also weighs on the speed of the recovery. With real estate markets, they're going to face challenges for a number of reasons. The chart that you see on the left is the difference between the 30-year rate and the 30-year mortgage and the Treasury, 10-year Treasury constant maturity. And you can see that that has spiked. So mortgage lenders are seeing real estate as riskier. We have unknowns about, is there going to be more, are the suburbs going to be viewed more favorably versus cities because of social distancing? Retirement communities and the like, are they going to go into decline as people don't want to go into the concentrated communities of older folks? Are there going to be increased preferences for healthcare intensive localities? Likely so. And during this recession, we'll have a reduction in residential construction, which here in California and in the Bay Area means that the affordability issue not only is not going away, but is going to get worse. So let me end and turn to questions with just some thoughts about this pandemic. It is unprecedented. Usually when you have cataclysmic events like this, it impacts society, it impacts the economic structure, and this is still playing out. But in the forecasts that you've seen, the severity, that it really depends on the severity of the pandemic. And our assumption, which gives us this relatively quick recovery in the US, is that we're on the backside of this pandemic come summer, that it starts to wane. When we get into the third quarter, it is really sort of receding, and that it does not come back in 2021. Keep that in mind, because to the extent that we're too optimistic, we're also too optimistic about the recession, both the depth and the duration of that. And some other thoughts. The support package that was rolled out, and that's not a stimulus, it's a support package, because you can't stimulate demand when you don't allow people to go out to actually express that demand. But it is a support package. It's slow to roll out. There are issues about getting these millions of loan applications from small business processed. And so that's going to be rolling out over the next month or so, but it's not immediate. Will the later stimulus be too late? This is being talked about in terms of a big infrastructure package, and our experience with infrastructure is that it's spread out over a long period of time and doesn't provide a lot of immediate stimulus. So that's something to keep an eye on as to what the structure of these are. Virtual meetings, learning, remote work is going to become a good complement to more traditional or work in the past. Automation and robotics adoption will speed up. And that's because when firms are hiring, they have to make a decision as to whether to hire capital or to hire labor. And automation and robotics are increasingly attractive. So that process, which has been going on for 20 years, is going to speed up. And importantly, unbridled globalization, that's killed off by this global pandemic. Globalization is going to be in full retreat, means there's going to be opportunities domestically, but some of the things that we are doing internationally will be going by the boards. And there's going to be discussion about the US social and health structures, and that will change. How that changes depends on how that discussion goes and what happens in the upcoming election. So those are my thoughts about where we're at, but keep in mind, we're in uncharted territory. We're doing the best we can to use economic models and our assumptions to come up with what this recession is going to look like and how we come out of that. But there's a lot of uncertainty as to exactly the pattern that is going to obtain. And let me stop right there and turn to any questions that you might have.
Thank you so much, Jerry. Just an initial question for you. So you spoke a little bit, of course, of industries that are suffering due to the impact of COVID-19. What are your views on industries that may grow because of COVID-19? And does California have the ability to perhaps benefit in terms of employment or output?
So I'm going to go bad news and good news. Bad news is that tourism and leisure and hospitality are going to be slow to come back. And that's because people have to feel safe if they're going to go on vacation. California is a location for international tourism. San Francisco and the Bay Area in particular, international tourism is probably dead for the year. But there may be more domestic tourism. I mean, one might expect that folks in the Bay Area, for example, will want to, once they're released from stay-at-home orders, go on vacation, but go someplace where they feel safe. And that may be wine country, or it may be coming into the city and so on. So you'll have kind of locally generated tourism demand that you did not have before. In terms of bars and restaurants, there's certainly going to be a significant portion of the population that, having been isolated for a while, just wants that social interaction. But it's not going to fully come back for a while. So that's the bad news. The good news is that this pandemic is going to increase the demand for technology, both hardware and software. And those are things that California and the Bay Area in particular are very strong in. And we expect that to be a growth industry and really to kind of take off as we come out of this recession. So there's at the high end, in terms of wages and salaries, the Bay Area is going to do better than the rest of the country. On the low end, there is, certainly a fairly big problem there.
Thank you, Jerry. So I'm just going to go over now to the Q&A, some questions for both you and Katie to answer. We have a lot here having to do with construction, so maybe both of you can dive a little deeper on the impacts of COVID-19 on the construction industry, both at the national level and maybe even down to looking at the Bay Area specifically. And kind of along those lines, there's some questions about funding at the government, at the national level, and helping to support local governments for infrastructure investment projects.
So who do you want to go first?
Whoever would like to go first. Jerry, would you like to start?
Okay, I'll start. You have to choose. In any recession, you're going to have a decrease in the amount of construction. And in this one, as developers make business plans, they're looking towards their buildings coming online in the 2021 timeframe. And if you don't know if there's going to be a vaccine, if you don't know if there's going to be another, kind of a double dip recession because of a return of the pandemic, it doesn't look as good, in terms of your business plan. It's hard to make that hunt. And lenders are also going to be wary of that. And so we're expecting a fairly sharp decline in residential construction. That can be mitigated by policy, but as yet that hasn't happened. California has a fairly robust infrastructure program that's funded by bonds, and that will continue. with respect to non-residential construction, it is far more expensive in a net present value sense, in a rate of return sense, to mothball a building that's partially built than to complete the building and then mothball it. And so projects that are underway, work in progress, we expect to continue, but as those projects come to completion, there really isn't going to be follow-on. And that's part of the reason why we have a slower recovery, that we're going to see layoffs in the construction industry that'll be more than 100,000. It does provide an opportunity for the state to step in, because building materials will be less expensive and construction labor will be available. But the private sector is really not going to do a lot through this contraction in the early part of the expansion.
Thank you, Jerry. Katie, anything to add on maybe what the national government can do to help support state and local governments in terms of infrastructure, investment, and just kind of helping the construction industry during this time?
Yeah, I mean, you're seeing a lot being done for state and local governments in terms of, some of the Fed lending programs that have gotten funding to the municipal markets for state and local governments. In terms of residential investment and construction specifically, this will be more of a prolonged contraction in this industry compared to the bounce back in consumer spending. So, for instance, you could see this really drag into the third quarter of 2020, some of this decline in residential investment. And then in terms of the government stimulus for construction projects, it'll really depend on, how the coronavirus cases peak. I mean, what I'm seeing now is a lot more financial market observers are looking more towards the health data than the finance data. So, if this, recovers in the next couple of weeks or months or even longer into the fall, it just is a very uncertain timeline. And I think the government's response will be, related to how we see the trajectory of new cases.
We also have a couple questions related to public transportation. How do you both see public transportation impacted in the long term? Obviously, we've seen a massive drop in ridership across the country on major transit networks. How might maybe the national government helps to support that, and what can state and local governments do to sort of work together?
So I mean, I can just, just quickly, I feel like the most important thing governments can do now is to get the health crisis under control. A longer term impact, if looking beyond the coronavirus crisis, there's going to be, still demand for, public transportation and the new transport economy. So I don't see it having a prolonged impact, but in terms of getting consumers feel comfortable to, make that transition, I think this transition time will be important. And that's really to focus on addressing the health crisis as quickly as possible. But the longer term impact would be, not as large as one might fear.
So I agree with respect to the longer term impact. But the near term impact is that this is really going to hurt public transit. However, there may be some real impetus to change the way we commute and to make cities friendlier for bicycle transport and the like. What's going to happen with public transit? I mean, if you look at, for example, Los Angeles, there is funded a massive public transit building project, and that's not going to stop. Ridership is another issue. and ridership will come back when people feel safe getting on buses and trains as opposed to driving in their own cars. But here in California, in the Bay Area, for example, there are real limits to choosing to drive your own car to work rather than using BART, even though BART is very crowded, but how many more cars can you get on the Bay Bridge, right? So people may want to socially distance by driving by themselves into the city, say from the East Bay or from the North Bay, but there are real limitations on whether or not they can do that.
Jerry, perhaps a question here for you. How do you see the higher education institutions being affected by this? And there's also a question here regarding the sports industry, particularly collegiate sports, how that impact combined with school impact might look in the future.
Sure. So I have no idea about collegiate sports and the impact. But my industry, my profession, we have made some innovations, but in many ways we've been doing what we've been doing for many, many years in the classroom. And at Anderson, we've been flipping the classroom. We've been having hybrid classes, which have used extensively the internet, and really trying to use new technology. So, what we moved to in distance learning is not as great a leap as it is in many other places. But it's going to impact higher education and the way in which we deliver education. And so disruptive technology may well be coming into higher education in ways that that we haven't really thought about, but I think one can expect that to accelerate. Right now we're doing all of our classes at the University of California, throughout the University of California system, online. I'll have students waiting for me in 15 minutes to, for online discussions. And some of this is really going to continue into the future, and that will change the need for brick and mortar universities and the way in which we operate them.
Just a final question for both of you as we start to wrap up. Just looking, a bit long term, what types of fundamental changes in our economy do you see staying in place even after the crisis eases? As both of you mentioned, of course, remote work is possibly going to be, something we see more and more in the future. But what other areas or industries may see sustained change? Kate, I'll let you start.
I think a lot of what was touched on earlier in terms of the shift from globalization to localization is going to be a key change in our economy going forward after COVID-19. We had started to see this already as the US and China had a trade war last year. Companies were starting to rethink how they did business, but I really think that this crisis in terms of the supply shock has really shown companies who do business globally that they need to rethink what's the best way to get their products to consumers. So I think you could see a change in businesses to adopt more localization strategies. For instance, a company doing business in China might set up an affiliate in China and provide services and goods just directly to those Chinese affiliates, as opposed to these supply chains that have been developed over decades with countless cross-border transactions with value being added on each step of the way. So I think you could see not just companies bringing factories and jobs home, but also, building their factories and jobs where their top consumers are. I think what also was touched on was e-everything, so e-learning, e-health, also e-commerce is going to be a huge part of how companies do business globally going forward, because as we've seen, the e-commerce adoption rates are still very low. So surprising, but only 15% of business and retail sales are done through e-commerce. I think you can really see an acceleration of that. And in terms of all of the electronic e-learning, e-entertainment, everything, it's really going to need some investment in the infrastructure. So 5G, fiber optics, we really need the infrastructure to be able to hold, you know, all of these increased demands online, data flows massively being sent overseas. Currently, the infrastructure is not there to be able to adopt some of these technologies of the future. So I think you could see government really start to invest in that infrastructure as well as healthcare infrastructure. But yeah, I definitely think that the e-commerce and localization trends will be some of the two biggest ones to watch.
Jerry, anything to add on that?
So I think that's spot on. We're going to have a discussion in the U.S. about what kind of healthcare system we have. I think that's going to be a serious discussion post-pandemic. Is what we have adequate? And I suspect that the answer is going to be no. And then the question is, how do we change that? And e-health is kind of one of those. The retreat from globalization means more manufacturing in the US, but it's not the old style of manufacturing. It's not going to be demanding riveters and metal benders, but rather robotics technicians, scientists, and engineers. So, the way in which we conduct education and get the workforce ready for that new reality of the 21st century is going to change. So that's just two comments that sort of reinforce what Katie said, that those are changes that have been coming for a long time, and this is going to accelerate them.
Great. Well, I think that's a really good place to end on. Thank you so much, Katie and Jerry, and all of you for joining us. This is really, really insightful. Just as a reminder to everyone, we'll be sending out a follow-up email with the link to this webinar, any resources that were mentioned, and our questions that were asked. We'll also be continuing to update both the Bay Area economy.org website and our Bay Area Council.org website with any resources, short write-ups on the economy, and information on our future webinars. And our next future webinar will be next Thursday. So thank you again, everyone, for joining, and we look forward to continuing to work with you all during this time. Have a good rest of your day.